Today, we are lucky enough to get our June State of Freight live and in person. This will have a question and answer session during our session today. So we've got 2 mics up in the main aisles. I think they're going to go about halfway through before we start calling for audience questions. So make sure that you've got those in your brain and you're ready to ask. You'll just pop up, form a line behind each of those microphones, and we'll get your audience questions asked. So right now for our June State of Freight, please welcome our FreightWaves Head of Market Intelligence, Zach Strickland, and our Founder and CEO, Craig Fuller.
I am a tiger, man.
Right? I mean, that's great walkout music.
That is great. It's sort of like the Rock and Roll Hall of Fame.
Dude.
By the way, did you play any music last night?
I didn't play, but I was an active spectator.
We did Shake It Off.
I was definitely pushing people out there.
It was good. It was good. It was a good show. Well, Zach, you and I do this regular conversation called The State of Freight that comes out once a month.
Right.
Where we just basically break down the market of what's happening in the freight market. So we're going to do this live today. A lot to talk about in terms of where the market's headed. So
yeah, let's kick it off.
Let's do it.
Let's get going. For those of you that haven't watched The State of Freight or listened to The State of Freight, kind of an overriding theme of what we've seen with the freight market and the overall economy has been to this real down cycle. We're downshifting out of a period, the pandemic era, still leaving its mark economically and subsequently in supply chains, all the way downstream to transportation. So this chart right here, the NTI and NTIL, these 2 charts, Craig, I think these are good lead-ins to kind of explaining where we've been and where we are today in terms of like how people relate to this market. Can you kind of...
Yeah, so I think it's important to note that what we're actually looking at is effectively the price of spot freight,
right,
which is the currency of our industry.
Exactly.
That's what when you talk to truck drivers, when you talk to most people in the industry and you ask how business is, they tend to refer to the market conditions through rates. Mm-hmm. Large asset carriers will think about contract and their rates, but largely the spot market is what leads. The L out of that is line haul only, right, which means net of diesel. So what we're looking at is the shaded gray area, that white area, white grayish, is with diesel, mm-hmm, and then the green is without diesel prices. Right. And you could see actually, if you could sort of go back to 2019, they were tighter, and now we're seeing really through the last year, it widened, but now it's starting to consolidate. Now, one of the reasons it's consolidating is that the price of diesel has come down significantly. Right. It comes down slower, frankly, than the market suggested it would, but that's largely because the large truck stops, yep, just are slower to address the retail prices. And again, that diesel price is assessed off of retail diesel.
Right.
And so that's why that variance. But we're starting to see the diesel price be less of a factor, mm-hmm, in the relative inflationary element, sort of normalized in terms of where things are at.
Right. What do you think about that? So March of last year, the freight market kind of collapses. The spot market.
I don't know that kind of is
it's
an understatement.
Yeah.
I mean, it's pretty far down.
But we started to see this kind of trough in May, and we've bounced back up to start the summer. What do you take from this? Is this something that you view as like a sustainable shift? Are we now done with spot rates
at the bottom?
Falling?
It's hard to know that. I mean, what I would say, and I said this yesterday and I mean it, I think the market is as opaque as it's ever been. I think it's actually hard. It's as hard to understand and draw any conclusions about the state of where the market's headed than at any moment in time since FreightWaves, right, once we started FreightWaves. And the reason I say that is that you can make the case that the economic data, the stuff that the Federal Reserve looks at, the fact that the stock market we're in a bull market apparently, and so if you look at the broader economic picture, people that are involved in Wall Street and the Federal Reserve and a lot of the major media that covers business news would suggest that the economy is incredibly healthy.
Right.
I think if you ask the folks in this room, as I have over the last couple of days, what's happening, you'll get a very different story. So the Main Street economy, right, the one that we care about, the goods economy, is incredibly bearish. And there's a lot of reasons to continue to be bearish. You have consumer spending that's tapped out. You have consumer credit is really what's driving consumption right now.
Right.
That's starting to get tapped out. You have student loan deferments. I mean, we've talked about this a number of times, but it is fascinating how much money was deferred during the COVID cycle. So, Donald Trump passed it in March of 2020. Biden continued it, I think 9 different extensions to student loan deferment. $385 a month for 3 years, over $15,000 of cash that was kept inside of consumer wallets. And all of that is going to resume by September. So by Labor Day, the consumers that deferred it, 25 million Americans, will end up having to pay an additional $385 on average. But some of these people had much larger. If you got some of the degrees, if you got masters or PhDs, we're talking about it. And you think about the people who consume the goods that drive the freight economy happen to be in the demographic that largely deferred. So you and I are of the age where for the most part, student loans of people that went to school with us have largely been paid off. But there's the people that largely consume a lot of the products that move in freight are that 25 to 44 year, younger people.
Right.
They're buying houses, they're buying furniture.
They need
have
stuff.
young kids.
Yeah,
whereas people at our age are largely established.
Yeah.
We're not buying a lot of furniture these days unless you're moving.
We're kind of like the cash cows of our life.
This is when we start to really start to make most of our life savings.
Yeah.
There was a great conversation, Peter Zeihan talked about it, is that the majority of your life earnings are from 50 to 60. That's when you actually start to accumulate wealth. And it's because you're not consuming products. Your kids are largely out of that. My kids are quite young. They'll be buying lots of products for a long time. But the group that's impacted by student loan deferment are the very group that drive a lot of freight demand.
Right.
And one of the things that we looked at is back in the COVID cycle is we looked at where we would see increases in freight demand. And there was a tight correlation between government stimulus within weeks of when that money hit the economy and additional surges. It almost looked like the market got a little bit exhausted. And then all of a sudden, boom, the government puts more money into the economy and consumers went and spent it.
Right.
And I think that's probably the biggest concern I have about the economy.
Yeah, just a lot of downside risks still in the environment. And again, the takeaway from this chart for me too is the fact that those two horizontal lines, one has fuel, the top one has fuel in it, the bottom one does not. And the green line, it's almost on par with where it was.
2019?
Yeah.
And 2019 was not a stellar year.
No, not
the bloodbath of 2019. I know everyone loves to hate that term. But if you think about it, we're back to where we were in 2019, where it was one of the worst freight markets in history.
Yeah.
And we are back on a rate per mile basis to where we were in 2019. And here's the crazy part, is if you think about it on a cash flow basis, trucking companies, I'm taking fuel out of the equation, but I'm talking driver salaries, maintenance, think about mechanics and equipment cost. If you look at it on a per mile basis, those costs are up as much as 30 cents a mile, increases in cost.
Right.
That's a cash flow impact to trucking companies of 30 cents a mile. We're back to where we started from. In fact, a little bit lower than we were.
Right.
You're talking about, from a cash flow basis, is that carriers have lost 30 cents a mile of cash flow. That's a significant issue. And we're comparing against one of the worst freight markets in history. And so it is incredibly bearish. Now, one of the things to keep in mind is that the number of trucking companies since 2019 is up over 25%. The number of registered FMCSA fleets, trucks that are available for dispatch, is up 25%. So in order to see a reset in the rate environment, you fundamentally have to have one or two things happen. You need a surge in freight, because this is a capacity-constrained market.
Demand.
You need additional demand. So make the case. If government has been predominantly driving demand through the benefit of consumers and just stimulus, I find it very hard to believe that the Federal Reserve is going to lax policy that's going to drive stimulus. I have a hard time believing that Congress will get anything passed to drive stimulus. So I don't believe we'll see demand hit. We have a lot of reasons to be negative.
Also, with a 25% bump, it'd be hard to get that level of bump, right?
Absolutely. So you almost have to churn through capacity. You have to, not almost. You have to churn through capacity before you see any level of stability. Now, I'm not suggesting that things get worse. There is an argument to be made that that the market cannot go lower
Right.
by much because there's a point when trucking companies simply don't take freight.
Right.
They just won't drive. They'll park their rigs. It's not worth it to take freight where they lose money, and we very well may be near those bottoms. So there is a case to make we could be near the bottom, but it's certainly not suggesting that there's going to be a sudden surge.
Yeah, and so I changed the chart over to the NTI straight up over the last few years, and really, my takeaway here, it's an interesting look. The trend line on this chart over the last couple of, it's changed from a pretty slow downward trend, and now it's kind of like having this hump to it.
Well, a little bit of seasonality.
A little seasonality, but still, to your point, with capacity still being so far above where we were, what is your takeaway that spot rates have
a little bit of that is road check. You had the road check
responsibility.
kind of surge. You had the end of June. Let's not forget that June is one of the best months of the year typically. You have a lot of reasons to be bullish in June.
Right.
Like you have the beverage season, the 100 days of summer.
Well, everybody travels.
I'm sorry?
Everybody travels. And
Everybody travels. Produce season is sort of in vogue, construction materials. So naturally, June is a strong month. But, I mean, look at it. I think that's not impressive.
Great. No.
by any stretch. And you're back to basically, again, trading near the bottom. So I think we'll see some level of sensitivity, but I don't think it's a bull sign. And we're talking about the end of June. Look at that.
Yeah.
I mean, we're already dipping into the July 4th.
No, it should be technically, if seasonality truly had returned to the spot market, we actually should see this kind of.
We should see it at least firm, and we're not. And I think a lot of what's happening is we saw some road check impact through mid-May, saw some increases, went into Memorial Day, and now we're starting to see the fact that we're at the end of June, or at least 3 weeks into June. Things are just going to be pretty tough into July 4th. And let's not forget that July is actually a really difficult month for trucking.
Right, it is.
Into August. And so I think I just can't be bullish.
All right, that's fair. A few of the nuances I've looked into here, of course, the West Coast.
And that orange, just to be clear for folks that may not be familiar with that.
Oh, yeah, and
orange is the COVID extreme.
That's the
I mean, it was like
COVID
down to
year.
$1.20 a mile.
Right.
This is the point when, if you remember, all those truck drivers, the owner-operators were protesting in Washington, demanding that the government investigate the brokers for lowering the rates. That was the point where there was a lot of stress in the trucking market. That was $1.20. I think that was what we call the extreme lows.
Right.
I don't think we'll see those levels, but just because that was when a point there was just any freight. The entire economy was shut down.
No, everything was shut down. I think the OTVI was down towards 8,000 or close to it. And speaking of the OTVI, pulled this one up. Now, this is going to be the demand side indicator. Outbound tender volume index counts the total number of tenders going from shipper to carrier under contract. And this did look like it was kind of on the way up.
It said the same thing that the spot rate stuff suggested. Is like you saw, actually, it looks a little bit more bullish than the spot rates. You didn't see the road check issue. You saw volume. We're measuring volume. But I want to point out that purple line, that magenta, I think it's magenta, purple, actually is 2019. This is volume. Now, this is going to measure both spot and contract, even though it is related to tender data.
Sure.
And it's actually starting to dip below that 2019 level. And so you have a volume problem now. We've talked about the oversupply to capacity that you get from the FMCSA data. We know there's been an enormous amount of growth in capacity. Now we have a volume problem. And we haven't, in my opinion, seen the worst or the significant slowdown in consumer activity that certainly suggests that it's on its way. I mean, look, the Federal Reserve, you know this because we talk about it quite often, the Federal Reserve has increased interest rates at the fastest level in terms of the acceleration of how fast they went from where they were before. And it's a new economy now. And I think a lot of the sort of frustration that I have with people saying, the typical cycle, talking about this 3-year cycle and things must get better, is they're discounting a difference in monetary policy. We're in a different monetary regime. A lot of the cycle that took place from 2009 to 2021 or even 22 was based on very low interest rates. We are in a different economy now, and we have so much capacity that's out there. And I think that's the part that gives me a lot of pause about how fast the cycle changes, is that we are in a different economy.
Yeah, I think too, the fact you just pointed out, the rate of change in policy, the speed with which we transition to inflation is transitory to we're going to jack rates up every single month.
Prime.
Yeah.
which is a fair market rate on
Right.
most interest, on most loans, sitting at 7.5%,
Right.
like well over 7%. And we're talking some of these, loans that you could have gotten were incredibly cheap. And just think about your mortgage. My mortgage is 2.75%. Like now mortgage rates are 6.5%, 7% if you have high quality credit.
People are not going to buy new houses if they've locked in these low
You're not
rates.
going to sell your house.
Yeah,
That's the
right,
issue.
yeah.
It's and so you have, the data is a little bit murky on how much the housing market directly or indirectly impacts trucking, but think about all the things that drive in that housing market impacts the trucking market. It's things like building materials, it's things like floor coverings, it's things like furniture and appliances. When people move into a house, they tend to make changes. At least that's been my experience. My wife always has. We've moved a couple times in in our marriage, and so when we've done that, we're always making changes. And when the housing market isn't liquid, because there's very little activity, it just means a lot of that consumption for the types of goods that move through the freight market just aren't happening. And so because of that, that's going to put a pretty natural lag on the freight market.
Yeah, and we haven't really seen that manifest yet, have we?
In terms of the...
Not fully.
No, I think it's still playing out. A lot of the construction that's happening, I think it's a fascinating conversation. So one of the big arguments I've heard over the last year is that, well, this is an oversupply situation, is that we've talked about the capacity getting supplied with so many new entrants into the trucking market. That's a fact. We know that. We've talked about it. But a lot of the folks that believe that have to look broader at the fact that this is a demand situation. We talked about OTVI. This is the LTL guys.
Right.
Now, LTL is a very different market than truckload, as you know. You worked in LTL pricing for an LTL carrier, so you know this better than most. The LTL market is interesting because it has a higher concentration of industrial activity than what the truckload market does. Truckload has higher concentration in the retail and consumer exposure. LTL tends to be a little tighter exposed, or a relative tighter exposed to the industrial sector. And it doesn't have the boom and bust capacity situation. There are significant barriers to entry in the LTL market. You don't see new LTL carriers automatically just start up because of the infrastructure you need. You do see some expansion, but it is a much healthier market. That's why you've seen Knight-Swift go out and buy an LTL carrier, and the LTL carriers trade at much higher multiples than truckload carriers do, because they simply have better unit economics. Now, one of the interesting things is to look at this data and look specifically at the volume data. Let's take Yellow out of the conversation for a second, because it has its own macro situation.
Right.
But let's look at Old Dominion, arguably the highest quality LTL carrier in the market. Its volumes in tonnage in May are off 14.4%.
That's a tremendous drop.
FedEx's report yesterday, and I know we're all here and maybe folks in the room didn't see it, their tonnage was down in their LTL business by 18%. We're talking about a massive drop. And we could talk about Yellow being a lower quality carrier or having its own macro issues. Old Dominion and FedEx actually are among the highest quality LTL providers in the market. They're facing significant headwinds. So this is telling me that our problems in the freight market are not strictly related to an overabundance of capacity, but rather a problem with demand.
And some of that demand too, we talked about this a little bit earlier. How much of this erosion in demand do you think has been, a situation where we had this huge expansion, this overheating of the economy for a while? How seriously do we take a 14%, 18% drop in tonnage from last year versus, say, the pre-COVID era?
Look, we're talking about a 4-year comparison. And we've talked about the fact we're relatively back to 2019 levels.
Right.
That basically means you missed out on 4 years of growth. If that's true, if we're back to 2019 levels, we basically have lost 4 years. In any economy, even if this was a normal economy and forgot the overabundance and overstimulus, if we went through 4 years of no growth, that would be a problem.
Right.
That would be a significant issue. But that's what we're talking about, is coming back to that. And we haven't even talked about the inflationary elements in the market. I had somebody here last night. They may be in the room. I won't call them out specifically, but this person has ran sales departments at two of the largest truckload carriers and a very large broker, and been in it for 30 years. And he told me, he's like, this is the most difficult market I've ever been in. He's like, worse than 2008, certainly worse than 2019.
Yeah.
This is the most difficult market that he's ever been in from a sales cycle. I know this is all depressing news. I wish we had better things to say. I would rather be the bullish person.
You were.
I was in 2020,
Yeah. 2020.
incredibly bullish.
Yeah.
But unfortunately, I don't have good news to share. And I think it is a state of the market. And I think as I look at it, we see a volume problem. And I need, one of the big arguments about the second half is this sort of thesis that we're going to have the second half surge. If you remember, we came into the year and almost every Wall Street analyst, whether it was the carrier side of the
Certainly
equation,
the
carriers were certainly bullish, but
Yeah.
even parts of the economy that are not in freight, the packaging materials manufacturers, everyone was sort of bullish on the second half. Hey, the first half's going to be soft, second half's going to come back.
Right.
And everybody sort of talked about inventory replenishment.
Yep.
Is that the idea that all of these retailers were going to burn off all this excess inventory and they had to replenish. But the part that I always struggle with that is replenish to what level?
Right.
Like if we're back to 2019, we're back to more normalized inventory levels. Are they really going to go back to where they were in 2021 and replenish the inventory they burned off? No, they had a problem.
Right.
They had a massive inventory build. So right now, if we're back to where we were and they're starting to run a more normalized supply chain and facing these significant headwinds, there is nothing to suggest that they're going to be replenishing inventory. So I think the second half story could be more challenging than the first.
I mean, do you think that even, we do have data that does support the fact that inventories have corrected to an extent. Do you think that that still might have a little bit of a bump? Because now instead of not ordering, they are going to order?
No, I'll tell you why.
Okay.
If you go back to the COVID economy, remember at the height of that, I had built onto my house, but effectively built a house for my large family of 5 kids. If you ordered anything in that period of time, anything, it felt like, you could be waiting weeks, in some cases months. Some of the stuff we ordered was 8 to 12 months behind. Stuff was out of stock, and we're like, hey, we'll notify you when it comes in. And then 8 months later, you're like, oh my God, this thing is coming in. It just is that way. I think what happened is that a lot of the companies ordered so much excess to prepare for that. But and because of the lead cycles, the lack of capacity, the lack of supply, and I think what actually happened is that now the cycle from the time they order a product to the time they receive it is now measured in potentially days or weeks. I have not found in the last couple of months anything that I've ordered that I haven't received quickly.
Right.
I can't remember the last time that I had to wait on anything that I ordered. And if you're a retailer or you're a wholesaler and you have access to capacity and you have access to product, you don't feel a need to have inventory on hand because it's available.
Right.
And I think everyone's worried about cash positions. CFOs, we've talked to a number of CFOs in our role. CFOs are very concerned about the economy. We know CapEx is being impacted. Talked to many of the freight tech companies here. They're seeing a significant slowdown in just volume of contracts because the finance departments are slowing down CapEx. And I think that cautious nature is going to start to continue to play out, particularly as consumers get impacted. Now, one of the factors that we haven't talked about is the employment picture.
Mm-hmm. Yeah, no, I mean, but the employment has been relatively strong-ish.
It has,
Yeah.
But how much of that's demographic?
Yeah.
So look at the sectors where you had a lot of retirement. So I think everybody knows I'm a pilot, and I track the aviation market. A lot of the airlines, one of the reasons they have pilot shortages is because they actually furloughed a lot of the pilots during COVID, and now the pilots either can't come back because of retirement age, or don't want to come back because they've just decided that there are other ways, they can fly for the charter operators and don't have to deal with sort of the regulations around the airlines. those are factors that are playing out in the economy. The demographic issue is a real issue. Peter Zeihan, when he was here at F3, as well as Friedman yesterday, we talked a lot about, have talked about the demographic issues. Is we have an aging population in terms of relative, just the way that the demographics work, and we don't have a lot of immigration in the United States. And because of that, it's actually created a significant drag, not to mention women. The workforce issues with, women have during COVID because of childcare issues, that stuff is dragging a large part of the economy. And so it's an issue, and employment's going to stay tight, which creates inflationary issues that the Fed's concerned about.
Right. So, let's move back to the freight market a little bit here. This is the tender rejection index, and this is one of the reasons I think that there is not a sustainable shift in the market yet. Everything that we saw in the NTI has a relationship with the tender rejection index. The higher the rate of rejection, typically that's an inflationary process. So the shipper gets rejected, and then they start trying to source capacity from other carriers, other sources, and it waterfalls into.
Let's just remind folks that are in the room that may not know what the tender rejection is. This measures the percent of freight that's turned down. So inevitably, in a routing guide, trucking companies, when they get an RFP, because these are largely contracted freight, will bid on every load or a large portion of loads and basically know that they're going to reject some freight. It's part of the routing guide acceptance. And the reasons they reject freight is certainly economics, so price is one reason, but also it could be they don't have a truck in the area, or they don't want to go in that lane, or driver wasn't available. So they reject freight for all sorts of reasons. There's always going to be some level of rejections. But if you look at this, so let's go back to this green line, even the purple or magenta, can we agree, is that purple or magenta?
Mauve.
Is it mauve?
Mauve, maybe.
Okay, so it's mauve. That mauve line right there was the COVID extreme. That was when the economy was shut down, carriers were willing, truckers were protesting, wanting freight. That's where we were back then in the COVID economy.
Right.
We're at 3.35% today. That means out of 100 truckloads, 3.3 on average are being rejected. Very small and insignificant. Now, if you go back to the 2019 levels, we were well above 5%. And this was the worst freight market since the Great Recession. Yeah. So we're talking about a situation where there is no increase in really any suggestions that the capacity map has been turned down. Now, a lot of folks, we do it as well, spend a lot of time trying to measure the amount of capacity that's entered the market or exited the market. And I think that's a useful exercise because it gives you context, but it doesn't actually tell you much about what's happening on a real-time basis because the data is so hard to, it's government data.
And counting trucks.
Counting trucks.
Are they in the right places too?
Is it actually measuring, what is it actually measuring? Are these available for dispatch? How many are just sitting at the house? It isn't that useful in understanding the dynamics of the market. The tender rejection data actually tells you in a real-time basis within 24 hours how the market's performing. What we know right now is the industry, the truckload carriers, are saying, I want almost every load I can get my hands on. I will take almost anything to keep my trucks loaded. Now, this message communicates to shippers when I have so much availability of capacity that they have a lot of pricing power.
Right.
Because if I'm accepting everything, the best way to drive pricing increases in the market, to get contract rate increases or even spot increases, is for a shipper, their routing guide to break down, for them to get a ton of rejections. That's the best pricing power that a carrier can have. And if the shippers are saying almost every load accepted, which at historical lows in terms of rejections or historical highs in terms of acceptance, then shippers feel like they have an enormous amount of power to drive down rates. And I don't see that changing because, again, you need demand or you need a capacity churn. And we're talking about a situation since 2019, an increase of at least 25% of the capacity market.
Right. And they were covering 25% more freight.
At the peak.
At the peak.
Absolutely.
They were doing that. That's action.
Absolutely.
Yeah. So let's move on to, kind of this is sort of a split of the tender rejection index. We showed you that it was, 3.35% in aggregate, but this splits it into van, refrigerated, and then flatbed. Now, the takeaway for me here, and
So
again,
that,
flatbed,
just real clear, for the folks at
green,
home.
Yeah, sorry, green is flatbed, orange is refrigerated, and the white line is van. So the interesting aspect of this for me, now flatbed obviously doesn't represent a huge portion of this data set by any means at 12.25% current rejection rate. Refrigerated comes in, a second place, and van is obviously the biggest portion of this total data set. But the fact that flatbed tends to come into alignment over time, and this is kind of an interesting upstream signal for me. So flatbed tends to correlate really strongly with housing, construction, industrial manufacturing, and energy.
Oil.
Yep. Yeah. And this has remained a much more active sector in our data sets. It's reflected in the spot rates as well. The spot rates for flatbed have been much more resilient than refrigerated and van. My question to you is, do you think this is some sort of aspect of the fact that flatbed really wasn't that active during COVID? It had kind of a, people didn't really, there wasn't a lot of flatbed freight relating to
In the early part of
in the early part of the.
I mean, but
it didn't come
housing
into later.
was insane.
Yeah.
But part of the reasons there wasn't a lot of activity is the housing market was strong, but builders couldn't get their hands on materials during that period. Was one sort of reality of it.
Supply chain
the
bottleneck.
oil sector, we think about oil now. If you remember back in the COVID extremes, oil was not just free, but it was actually negative. There was a period when you actually got paid to move oil. I wish I had taken out some speculative bets on oil and gotten paid to move it. But it was an insane time. So you're correct in the sense that what we see in flatbed is there was some sort of unique anomalies that existed in that data. One of the things that's holding up the flatbed market is, there's been a lot of this infrastructure bill is driving a lot of sort of government projects. We've seen like airports, LaGuardia. Have you been to? You probably don't go to New York very often.
No.
But the LaGuardia terminal is probably one of the most impressive airport terminals I've ever been in. That was sort of started before COVID, but it's finished. But we also see highways. So a lot of infrastructure is being developed. Energy has stayed incredibly robust. And so that is driving some of that. But it also it has pretty significant boom and bust cycles in its own right, but it doesn't look like the van market because it just has its own set of restrictions.
Right.
You can't take a van truckload and move it into flatbed, and you can't take flatbed typically and move it into truckload. Most commodities don't work that way, some do. But it's not as fungible, if you will, as compared to, say, the reefer market and certainly the van market. So that's why it sort of operates on its own thing. Now, one of the things we have seen, which I think is really interesting, is single housing starts. Builder sentiment actually is up, and single home starts are actually starting to show maybe that market has bottomed because people now have accepted interest rates. I mean, I remember when interest rates were in the, when I was in college, you're talking about, double-digit interest rates for mortgages.
Right.
And we're now looking at a situation where 6.5%.
Still
I can't remember what my mortgage was. It felt like it was 7.5%. When I first got a house, 6.5%, 7% is cheap, or at least market. It feels expensive when you compare it to 2.5 or 2.7, but.
Yeah. So real quickly on the CLAV. So this is basically the accepted tender volume. So everything that a carrier accepts on their load request, we index this one. This is just more of an illustration of where we are historically speaking. Like, this is I wrote an article on this, basically calling, the 25% higher volume coverage there in the blue line at the peak COVID activity being higher than it was. I think it was March-ish when it was 25% higher. That gap is shrinking. Now, we've got a little bit of a downtick here in recent days. I don't know, like you said, there's a lot of sustainability issues here, but what's your takeaway from the CLAV right now? It doesn't look as in alignment with that 2018 or 2019 mauve color. It looks like it's a little bit better, though it is starting to get
It's
closer.
certainly reacting faster than what you would have seen more aggressive. Look, I've said this and I'll say this again, is the market's as opaque as it's ever been. It's hard to predict the direction. I certainly am bearish, as I've been pretty transparent about that. I cannot make the bull case for the second half.
Right.
I can make a lot of reasons of why we may it may not be as bad. Like employment numbers strong. Stock market is suggesting that maybe things are getting better, or at least good. But I can't make a bull case. I can't make that we're on a bull run. I can make an enormous amount of case on why things can get worse, and it tells me as I lean into it.
Well, this looks
that,
like your case is in point. Like,
well, we'll
can
see.
get
I think we have to look at what happens in July.
Yeah.
Like the market, let's see how it returns. But I think there's a pretty strong case that the second half is going to be quite challenging.
Well, look at the historic. 2019, July is actually a softer month historically.
Always a July. July 4th is a part of that factor, but
Yeah.
July is always a soft month. It just is.
You got a vacation in there, a vacation period.
Companies don't do it. Now, once you get past Labor Day, we start to think about the holidays. And look, I can't make a case that the holiday season is going to be incredibly strong. I think retailers have been burned with too much inventory.
Yeah.
They're also worried about consumer activity. And if they can't make a bull case about the second half and the holiday season, then they're not going to order a ton of product. I think one of the things I've heard from a number of folks in the retailers is that in this holiday season, they would rather have a stock out than too much inventory. That's the leaning in that they're okay with some level of product not being in store, at least temporarily, and they'll miss out on a couple of sales than be oversupplied, which is certainly a different story than we were even a year ago.
Yeah, for sure. So let's move to the contract rate side of things. This has been an interesting dynamic over the past, I guess, year now, where contract rates have been moving in a different sort of pattern than the spot market, obviously, as it always does traditionally. Spot market's a lot more volatile because it's daily negotiated prices. The contract rates tend to be negotiated on 3 to 12-month cycles. That can change, of course, at times, and it did during the pandemic. But contract rates in general, if you can't read that, the mauve line up there is 2022, and that's 17% down. And the white line is 17% down from where we were this time last year. But it's still 19% higher than the 2019 orange line there.
Yeah, I mean, look, I think there's two fundamental reasons for that. Number one is that when you assess the contract market, you're dealing with some of those contract bids that were put in, even a year ago, or even 14 months, 18 months ago, some of it. But that sample size continues of stuff that's sort of longer dated continues to decrease. Because this is looking at freight bills that are being paid in the contract market. And as they get paid, some of those rates were set a year ago or even 2 years ago. And so as those old rates burn off, because not every shipper puts things out to bid, and not every shipper, in fact, most shippers don't immediately go to the spot market. It's just extra work.
Right.
Especially when they're seeing some level of decrease. The CFO's like, I want decreases, and like, congratulations, I'm giving them to you. But it's the market conditions. So like, as those older rates burn off, and they're able to secure capacity, then we will see a continued decrease of rate. But it's going to continue to trend down. We don't see any suggestion with spot rates being so variant and so wide. I don't know if we have the rates chart.
Oh, but we do.
So this is my favorite.
Why would I leave
all
it
the
out?
charts we have inside of SONAR, this is my favorite.
Yeah.
So what this measures is the delta between spot and contract.
Yeah.
And if you think about the markets, the word contract, for anybody that knows anything about trucking, knows that it's not a true contract in the sense that I'm going to give you $100 million of freight or $10 million of freight or $1 million of freight, and you can sue me if I don't give it to you. Contract is just a rate on file.
Right.
So it doesn't mean what most people would assume a contract rate means. But what this tells you is the variance between spot and contract. How much cheaper today, or in the case of grain, how much more expensive it was to move freight between in the spot market versus contract market. It's 78 cents cheaper today to move freight in the spot market than it is the contract market. Now you go back to 2019, that range was 35 cents to 50 cents cheaper. This is where the brokerage margin lives.
Right.
Like a lot of brokerage margins lives inside of this. Like brokers want a wide variance in spot and contract, particularly if they have locked in contract rates, because they can buy in the spot market cheaper.
Right.
And so because of that, what we're looking at is the fact that we've gone to as low as almost $1 a mile cheaper. We're at 78 cents, but it's still high compared to historical norms. This tells me that the market, A, cannot bottom until it resets, and B, is that one of two things have to happen. Spot rates need to come up, or contract rates need to go down. Now, we're talking 35 to 50 cent delta talking about 2019 levels.
And it's been sustained at an extreme
wide gap.
Wide gap.
But it's because contract rates are just stubbornly, slowly coming down while spot rates react to market conditions.
Right.
What has to happen is either spot rates need to come up to more normalized levels or contract rates need to come down. And because capacity is fungible, which means even though I may have contract rates, I can effectively order a truck and buy it on the spot market. It means until we see a more normalized level, it's hard to make the case that things have bottomed.
Right.
And so I fundamentally believe that what will happen is the spot market we know is traded to the bottom. It's going to continue to pull on that contract rate.
Right.
And until we see that variance get in a much more narrow level, it's hard to make the case that we are at the bottom or anywhere near it.
I want to ask you a question a little off script here. One that concerns kind of the shift in freight patterns in the United States. We see it in the tender data. We can see that there is a measurable shift from volume coming off the West Coast and it's shifting to the East Coast. We've talked about this in the past a little bit with Texas being a strong growth market. How much of this do you think is a sustainable change in the way that freight is moving? And how much of an impact do you think that it will have on market conditions?
Look, I think there is some truth to the fact that some shippers have sort of learned that the East Coast is an attractive market to bring freight in. But there are also factors, the West Coast labor issue is bound to get, it's resolved, but I think they have to vote.
Yeah,
we're waiting for the official stamp, but that sounds like that's done or will be done. One of the things that nobody's talking about is the Panama Canal, the fact that there is less water in the canal. There's significant issues as it relates to just water levels across the canal. And so that may impact some traffic going East Coast. Mm-hmm. You do see a permanent changing of supply chains. I think that's a fact. I think reshoring is a fact. Mm-hmm. We've seen in the data that Laredo is one of the strongest markets in the country as freight shifts from that south or north to northbound freight levels. That's going to continue to play out. Mm-hmm. But let's not forget the fact that it takes years, if not decades, to move supply chains. You can be long-term bullish, as I am, on reshoring and remanufacturing back into North America, and still incredibly bearish on short-term conditions. So I'm incredibly bullish on the American story,
right,
and what that means for freight in the long run. I'm incredibly bearish short-term because I think it's just going to take so long. One of the other factors is a large part of the economy. You think about the retail spending season. 40% of a retailer's business is related to holiday activity. So it's really that Halloween to call it New Year's. We'll give it really Christmas.
Right.
That season is 40% of a retailer sales. Mm-hmm. Retail has a much higher proportion of freight in the second half of the year than it does the first half. Largely consumer. And let's not forget where most consumer products, or a large percent of consumer products that are shipped internationally come from. It's Asia. Mm-hmm. I think with the West Coast port strike being resolved, I think cheap available capacity off the West Coast and trucking rates and rail intermodal, yep. I think most shippers are going to look at the West Coast as a really attractive market this year, different than perhaps they did last year. They don't have to worry about a labor issue. The West Coast can handle an enormous amount of volume. Mm-hmm. And I think because potentially the Panama Canal will have challenges this year due to the weather, climate issues, I think we could see sort of a resurgence of the market share for the West Coast versus the East Coast.
Interesting. All right, well, I'm going to pause here. We've got some mics positioned on the right and the left of the center aisle here. I want to give the audience an opportunity to ask us questions. So feel free to walk up to those mics, form a line if you need to or don't, and ask us what you think. All right, looks like we got one.
Afternoon, gentlemen. Carl Williams from True TMS. What is the ideal or normalized load tender rejection index where it's, as a carrier possibly, that it's that's where I like to see it, because it means things are pretty solid. Is there a range or a number?
So I'll answer this and I'll let Zach take the second half of that conversation. what I look for is really direction of the charts. Anything below 6% is just a very soft market. Anything below that is a pretty bearish sense, regardless of the direction. But one of the things I would look for is once we get above 6% and we see continued increases in rejections, it certainly suggests that the market is starting to stabilize. That's what I would look for. For me, anything below 6% is incredibly bearish. I think you said 8% in the past.
No, 6% is about on par. I think when we were in the 2019 era, it was a 5 to 6% on average, which wasn't. I mean, that was a deteriorating market from a rate perspective. But for me, it also depends on the absolute value. Like 10%, if it stays at 10%, rates go up. If it stays at 3% and goes to 4%. Rates can get a little bit wonky there too. It's not always deflationary, but I think an equilibrium-ish market is one where you have non-seasonal rejection rates around a 4 to 6% area, and then the holidays have sensitivity that pushes them closer to 10%. And I think that's what you would have with a market where traditional capacity is sustained. So from a shipping perspective, you're going to have reasonable availability throughout the year. But these seasonal fluctuations then have a deteriorating factor. What we have right now, seasonality, it doesn't jump up around the holidays. It's not even where we would consider it to be stable at such a low level. So I don't know if there's a true normal in that scenario, but it is. I think the environment that a lot of people have grown accustomed to would be a 4 to 6 with a spikes around the holidays.
So could we say then that it's good for both parties, so to speak? It's, the industry's level. I mean, we always want to make more as a carrier, obviously, but, being in a fair market, I mean, do we think is that even a thing you can say,
I think that's fair. I mean, I think shippers don't want their routing guides breaking down. I think it's a negative. One of the things that carriers talk about is, go back a year ago or 2 years ago for that matter at this point, and how great things were and how many folks in the market. I heard it from shippers, I heard it from logistics folks, I heard it from carriers. It's a super cycle. It's going to go on for years because of the unemployment data story and the lack of availability of drivers. But what we saw was with those super high rejection rates that really right below 30%, is that drove the rate environment so high that it became incredibly attractive for everybody to enter the market. I think what I would want if I ran a trucking company is just market stability. I'd want to be able to almost have an annuity in terms of predictable freight demand. I think shippers would want the same thing. I don't think most shippers want their routing guides breaking down. I know they don't want the routing guides breaking down, and I don't think they particularly love a very soft market. I think they want stability as well. They want trucks to show up, and they want to be able to have budgetary prediction. I think you want to see stability. And so, my answer is a little different than Zach. 6% is my take, but I'm more interested in the direction of the chart. I don't want to see a lot of volatility in that number. I don't want to see a continued acceleration like we've seen in past cycles. I want to see market stability. I think to your point, it's a win-win. If we can see the market stabilize above 6, 8, 10% by the end of the year, and some reaction to the holidays, I think that's a really strong sentiment. The last thing you want is an attractive market for new entrants if you run a trucking company. You don't really want a lot of new entrants into the trucking market, because if they enter the market, it's going to create the bust cycle that we see right now.
Yeah, and that's why.
Thank you.
Yeah, that's why this rejection rate, this is actually not a good thing for anybody, because this means that we have capacity that's coming out. It's going to come out.
It has to come out.
Yeah.
I mean, one of the challenges of the conversation of the driver shortage, and I know I'm like touching a really touchy issue for some folks, is that narrative is played out, and it all of a sudden creates this desire for new entrants into the market. If you read about a perpetual driver shortage, you believe, hey, I'm not going to have any issues finding, trucking's a really attractive market a year ago where you could make $300,000 to $400,000 a year.
Right.
Like, some of these guys were doing that. And I talked to a number of people who knew I had something to do with freight. Like, hey, I had a guy who was building a retaining wall, and he said one of his friends was in the insurance game. decided he wanted to enter the trucking market, no experience, and went out and bought 100 trailers and a bunch of trucks and was now a trucking company. And I was like, does he know anything about it? He said, no, he's never been in it, but he's making money hand over fist. And I said, good luck, because that's exactly what he's having to deal with now. Go ahead, sir.
Yeah, given the inflationary pressures on trucking companies across America, on fuel, labor, maintenance, what do you think the new break-even is?
It's a great question. JP Morgan did an analysis. Let's take line haul, take the fuel cost out of it. Their break even was around $1. They had ranged it, so they provided a range. It was like $1.56 to $1.90, depending on the cost and operating performance of the carrier. Again, net of fuel, line haul only. That's what they had tracked. And I think, what are we at, $1.50, $1.63 or something?
We're right above that. We're right around 160 something, yeah.
So we're at the low end of that range for break even. I've heard numbers that have been much higher than that, but we're not seeing, one of the things that we have the benefit of an editorial team that reports on any sizable bankruptcies that happen in the market. One of the things I've not seen, we've heard a lot about a lot of the carrier operating revocations. We're not seeing a wholesale level of bankruptcies like we saw in 2019. That is an interesting development, because you would think about the fact that the conditions are so soft, volumes are so soft, rates are so soft, that you would expect to see a substantial amount of bankruptcies. We're just not seeing wholesale bankruptcies. We were reporting, at one point, we were reporting as many as 10 a week. We may get 1 or 2 a month that are of any level of scale. So it just tells me that there is, a lot of these guys are hanging on, probably really built up their balance sheets during the COVID economy. And it may be a while before we see a significant wholesale of bankruptcies.
One more question, and that's, given the age and the number of miles on trucks in today's market, how long do you think it's going to take to pull some of the additional capacity out?
Yeah, it's a great question. I mean, one of the things that has happened over the last couple of years is that carriers, because they couldn't get access to new equipment, just held on longer. They went from normally turning them over in 3 to 4 years to maybe holding on to them to 6 to 7 years. The quality of the trucks are better than they have been in the past, which gives them a little bit more variance, and I think they were able to test that out. It's probably the reason that they held on a little bit longer, is because they largely have, potentially financing their trucks at cheaper rates, being able to run them a little bit longer. But that maintenance, anyone who's been in trucking knows that maintenance adds up over time. And the age of the truck or the amount of miles directly correlates with your maintenance expenses. And so I do think we will see an enormous wholesale level of bankruptcies accelerate as we move into the second half of the year, particularly if we don't see any levels of surges. Small guys one of the things that we never talk about, guys with single truck operators don't file bankruptcy.
No.
They just hand the keys into the lender.
Yeah.
And they probably, maybe they have some debt to pay off, but they're not filing bankruptcy. So it's the ones that are sort of 10 trucks to above that you would see it, but we haven't seen a wholesale level of bankruptcies.
Thank you.
So to answer your question, I think going back to what we said earlier is, again, this gives us context. But really the mathematical element, the data-driven element that I look for is that rejection rate. We will know when we see it. We'll see that, like I said, for me, it's anything above 6%. And an increase in rejections would suggest that we're at a point of capacity charting. But I don't see anything that suggests that's going to happen anytime soon.
Thank you.
Yeah, you wrote an interesting article on the Class 8 truck orders.
Yeah, one of the things that has happened, so I'm very active on Twitter.
Yeah.
Anyway, you can follow me on @FreightAlley. One of the things that has gotten a lot of play among folks that don't actively track trucking, the trucking market, is the fact that the OEMs have actually had a robust
or record orders last year.
Yes, but it's also very robust orders. And one of the things that a lot of people say is, hey, this is a sign that there is no recession, because it tightly correlates to recessionary activity. In fact, truck orders go, they bust every time there's been a recession. So it's over the last, I think it's 75 years, it's sort of, in order to have a recession, you also have a truck order bust. What is not factored in that story is the fact that over the last couple of years, a lot of the fleets could not get access to equipment. So if you go back to 2020, a lot of them, because they were just concerned about the state of the market. So think about the large fleets. They're turning their trucks over in regular cycles of 3 to 4 years. Some, as long as 5 years, but not longer than that, because they know that if they do that, maintenance expense adds up. In 2020, because we were in an unprecedented level of concern because of COVID, they just simply froze out all their orders. They just simply stopped ordering trucks. Then you had significant, once they realized, hey, things are okay. A friend of mine that runs a truck driver recruiting agency, and I remember in early August how he was talking about trucking companies. This was August of 2020 when the market was starting to heat up. Was talking about trucking companies actually were firing drivers that were poor performers because they had the opportunity to do that. All of a sudden, by September and October, that changed.
Right.
But in those days, they just didn't have a lot of standing orders. And then all of a sudden, we started to put new orders for trucks. They couldn't get their hands on them, all the way through really 2022. So we had a situation where they ran their trucks longer. They were not able to get access to new equipment. And that has predicted the order cycle. That's forced a lot of that. So what's happened is that a lot of them, the manufacturers were not taking in new orders when they couldn't get supply. So a lot of this is sort of backlog of orders. The way that the data is treated is sort of a backlog. They're going to have an order, but it actually is not processed in their systems until that's out. So what you're actually looking at is sort of a significant lag in data. It's very possible that the truck manufacturers missed the entire recession. It is possible that we could go through a cycle because the big consistent fleets are always ordering trucks.
Right.
The other thing that happened during the COVID economy is getting access to drivers. I'm not talking about in August 2020, but I'm talking about in 22. Is the employment picture was so poor for a lot of the large fleets, they couldn't get access to drivers, and the last thing you want to do is have a bunch of new trucks delivered and have them sit against a fence.
Right.
And so a lot of the trucking companies, because they could not get access to drivers, were actually slower to sort of respond to ordering new trucks, and that's all sort of caught up now.
Yeah, I mean, it's fascinating because a lot of people were pointing to, I think you pointed it out, that people were looking at, well, look at Class 8 truck orders. There's so much change in relationship with data and how it's traditionally been viewed over the last few years. I think COVID has kind of broken apart some of those traditional relationships. I mean, we were looking at with employment. Traditionally, it was very stable relationship between the rest of the economy, and now it's very fragmented.
There is an interesting theory that I have read that I believe is that, we have this definition, economists have definitions of recessions, but they conveniently changed the definition of recession. It's supposed to be 2 quarters of declining economic activity. Of course, that didn't count last year, but we'll put that aside. But there has been a discussion about different parts of the economy have had recessionary activities over the last couple of years. So if you think about it, everybody was sort of faced with some level of detraction or recession in the early parts of the COVID economy. But it wasn't really until 2022 before the airlines saw it. They had their recession in 21. The airlines and the hotels really faced tremendous economic pressure in 2021 because nobody wanted to travel.
Yeah, we've almost traded places.
Whereas housing saw a really boom cycle and has sort of been facing its own level of recession. The goods economy that we all care about here has had its recession that started, depends on how you define it. At least we've been in it for 6 months. And so it is possible. The auto market is incredibly robust, but the used cars and automobiles are starting to pile up in dealers. There's so many things that are broken. It's just interesting. We have 2 questions.
Yeah. How do you think the companies moving all their manufacturing or a lot of their manufacturing to Mexico and Canada is going to affect our domestic market?
It's a great question. I have done, we occasionally do site selection studies. I did one for a large financial institution that was looking at warehouses. We looked at every port city along the Mexican-U.S. border to figure out where truck activity and clearings were happening in demand. The only port in the United States that was seeing substantial, massive increases, I'm talking high double digits of increases over the pre-COVID cycle, was Laredo. So I think, Laredo is now, I think it's reaffirmed itself as the largest port in the United States. I think we'll continue to see that southern Texas, Laredo market continue to be incredibly robust. I was really disappointed, frankly, in like Juarez and El Paso. I would have expected to see great activity. I was also disappointed in Nogales and Tijuana. It was Laredo, so I think we'll continue to see it. More north-south domestic transfer. I think the Kansas City Southern transaction will just improve the velocity of northbound intermodal. I think those things are incredibly positive. Yes, sir.
Hello, I'm back. So what are the indicators telling us then about the truck market with new trucks? If more trucks are going to be purchased, I don't know, in the next 12 to 18 months, that's going to flood the used truck market possibly some. So what are we seeing with, price of new trucks, price of used trucks, availability?
I mean, new trucks are up as much as 20 to 25% versus where they were pre-COVID. Because the manufacturers could not produce trucks at the levels of pre-COVID levels for as much as 18 to 24 months during COVID, it actually means that there isn't going to be a flood of high quality, low mileage new trucks hit the market.
Right.
I mean, some of these carriers that normally turn trucks in at 3 to 4 years have been running them 6 to 7. And we're talking some of the highest quality public truckload carriers ran them a lot longer, so than they normally would. I don't think we'll see a glut of used trucks hit the market simply because a lot of the stuff, or high quality used trucks,
Right.
hit the market because a lot of the stuff that would be released were just ran
hard.
And no one really wants, you'll see the dray operators and others that will pick up some of the older model trucks. No one really wants to buy trucks that are 7 years old.
Right. All right.
Well, thank you so much. Appreciate you guys coming. All of our data that we've shown today is on our SONAR platform. You can find out more information at the SONAR booth. And any other questions, feel free to come by. So thank you so much.